Welcome back, everyone. By now, if you've been following along, you've not only learned the mindset behind investing, but you also know your options and how to place that very first trade. Today, we're going to level up. Let's talk about building a portfolio. Because investing isn't about a one-time $100 play, it's about creating a structure that can grow with you over time.
Exactly. Think of it like building a house. That first $100 investment is just the foundation, but a house needs walls, a roof, and a layout that works. Your portfolio is the same. It needs balance, strength, and a design that protects you against storms while still letting you grow.
What is a portfolio? So let's define it clearly. A portfolio is just the collection of investments you own. That could mean a mix of stocks, ETFs, bonds, maybe some crypto, and even cash savings. The point of a portfolio is to spread your money across different places so you're not relying on just one thing.
Right. Imagine putting all your money into one company. If that company tanks, so does your money. But if you own a slice of hundreds of companies through an ETF, plus a little in bonds, maybe a sprinkle of crypto, you've built resilience. That's diversification.
Step 1. Decide on risk level. So the first step in building a portfolio is asking yourself, what's my risk tolerance? Are you okay with big swings up and down if it means potentially higher returns? Or do you want steady, slower growth with less drama?
A quick rule of thumb, younger investors usually take on more risk because they have decades to recover from downturns. Older investors, or anyone who can't stomach volatility, lean toward safer assets. With $100, risk is less scary because the stakes are small, but building habits early matters.
Step 2. Core versus satellite approach. I like teaching beginners something called the core and satellite approach. Your core is the safe, steady part of your portfolio. For most people, that's a broad market ETF like the S&P 500. That could be 70 to 80% of your money.
And your satellites are the smaller, experimental bets. Maybe that's an individual stock you believe in, a little crypto, or a bond ETF. These satellites give your portfolio personality and potential upside, but they're not the whole house. They're more like the furniture.
Step 3. Scaling from $100 to $1,000. Okay, so what happens after your first $100? Let's say next month you add another $100, and the month after that, another. Suddenly, you're at $300. With each new deposit, you can rebalance.
For example, maybe you start with $70 in an ETF, $20 in a stock, $10 in crypto. When you hit $300, you might have $210 in ETFs, $60 in stocks, $30 in crypto. Still the same percentages, just scaled up. That's how you grow systematically.
And when you reach $1,000, you can consider adding new categories, maybe real estate ETFs, international stocks, or even small cap funds. The point is, you're expanding your toolkit as your money grows.
Step 4. The role of cash and emergency funds. One thing we should highlight. Never confuse your investment portfolio with your emergency fund. Before you get too deep into investing, make sure you've got some cash saved for unexpected events, car repairs, medical bills, things like that.
Yes, a lot of beginners skip this step, then end up selling investments at a bad time just because life threw them a curveball. Having at least $500 to $1,000 in emergency cash gives you peace of mind to let your investments ride long term.
Step 5. Review and rebalance. Now, let's talk about maintenance. Once your portfolio grows, don't just set it and forget it forever. Every few months, check in. If one part has grown way more than the others, rebalance.
For example, maybe crypto goes wild and suddenly it's 25% of your portfolio instead of 10%. That's more risk than you planned for. Rebalancing means selling a bit of the overgrown part and moving it back into your core. This keeps your plan intact.
Step 6. The psychology of scaling up. Here's the part nobody talks about. Growing your portfolio is as much about psychology as numbers. When you see your $100 become $500, then $1,000, it feels incredible. But you'll also feel fear when markets dip.
And that's where discipline comes in. Remember, dips are normal. They're buying opportunities, not disasters. If you panic and sell every time your portfolio drops 10%, you'll sabotage your growth.
The key is consistency. Keep adding, keep rebalancing, and trust the process. Over 10, 20, 30 years, the habit of steady investing is far more powerful than trying to time the market.
Closing part 4. So today, we built on your $100 by showing you how to structure a portfolio, balance risk, and scale up as you add more money. You now understand diversification, core versus satellite strategies, and the importance of emergency funds.
And in part 5, we're going to wrap everything together. We'll talk about long-term strategies, common pitfalls to avoid as your portfolio grows, and how to think like an investor for life.
That's where the real transformation happens, shifting from someone who invests to someone who lives with an investor's mindset. You don't want to